What a business owns is always equal to what it owes.
That's deceptively simple.
Told ya. Now, let's try to also understand it. But first, tell me, do you know the accounting term for the things a business owns?
Aren't they called assets?
Correct. And what do we call those things that a business owes?
Liabilities.
Yes, you're right. But only partially.
How so?
The amount of money that a business owes to outsiders is called liabilities, and those outsiders are called creditors. But a business also owes money to its owners, and we call that money capital.
So, the amount of money that a business owes will be equal to the sum of liabilities and capital?
Correct.
So, our above equation, which is what a business owns equals what a business owes, becomes assets equals liabilities plus capital.
Good work there.
Thanks.
Now, let's move on and understand the effects of business transactions on each component or variable of the accounting equation, and also the accounting equation as a whole.
Oh, that sounds exciting. Let's start.
That's the spirit. Let us first take a look at a balance sheet of a business. The balance sheet of a business shows the position of assets, liabilities, and capital of a business. This follows the accounting equation. Here, assets include cash, trade receivables, also called debtors, inventory, property, plant and equipment, and investments. Likewise, liabilities include trade payables or creditors, loans, and bank overdraft. And finally, capital is the amount contributed to the business by the owners. This section will also include the profit made by the business.
Oh, I can see that the balance sheet is divided into two parts, assets and capital and liabilities, just like the accounting equation. And also, the total amount on both the sides are the same.
Good observation. The total assets and the total liabilities, which include the capital of a business, always follows this equation and thus are always equal.
So, could you explain the equation with an example?
Sure. Let's suppose a person named John starts a business with a cash of $10,000. Now, what do you think will be the accounting equation here?
As John is the owner, the amount he invests in the business becomes the capital.
Correct. So, as the business now has $10,000 in cash, what is this cash for the business?
It is an asset for the business.
Correct again. So, can you show this as an accounting equation?
Sure. The accounting equation for that would be asset equals capital plus liabilities. Here the total assets is equal to $10,000 and the capital equals $10,000 too. Also, as we do not have liabilities, $10,000 on the asset side as cash equals $10,000 as capital on the capital and liabilities side.
That's right. Very well done. Additionally, you must always remember that every new transaction changes the value of assets, liabilities, or capital. But the accounting equation always holds true.
Got it. So, let's assume the business purchases goods worth $1,000 in cash. How will that change the equation?
I challenge you to try it yourself.
Challenge accepted. So, we used cash to purchase the goods. Therefore, the cash, which is our asset, decreases by $1,000. But at the same time, it increases the assets due to the purchase of goods worth $1,000.
That's right. Now, can you calculate the new equation?
That should be quite straightforward. Considering the previous equation, which was assets equals capital plus liabilities, our new equation would look something like this.
Finding this helpful? We have additional learning resources to offer. For Cambridge IGCSE and AS A-level subjects.
Well, that was pretty impressive. Good job.
Thanks. Also, I can see that the accounting equation always holds true, just as you said it would.
Of course.
Yeah. Let's do one more example.
Sure. Let's continue with the previous example. What would happen if the business now purchases furniture worth $15,500 for its office on credit and also pays rent of $500 for its office?
The furniture, which is an asset, increases by $15,500. Also, since it is bought on credit, we have to pay it in the future. So our liability increases by $15,500.
That's right.
Moreover, when the rent is paid in cash, assets decrease by $500. And rent, what effect does the rent have here?
In this case, you must remember that anything that impacts the profitability of the business should be adjusted to capital.
So the rent expense should be adjusted to capital because expenses decrease the profit?
Indeed.
Then, in that case, we deduct $500 from the capital as such.
Correct. You're doing great.
So, what other things impact the capital?
Well, you already know that the capital increases if there is a profit and decreases if there is a loss. So anything that creates a profit or a loss impacts the capital.
In that case, expenses like rent, wages, stationeries, electricity and water expenses, telephone expenses, and other day-to-day expenses decrease the profit and in turn the capital, right?
Correct. Additionally, the income generated by the business increases the profit, which simultaneously increases the capital.
Got it.
Great. Now, let's use an example to illustrate what we've just learned. So, what would happen if the business owner withdraws $5,000 in cash for office use?
Well, the asset will increase by $5,000 as the cash would increase. Simultaneously, there is a decrease in assets by $5,000 because the bank balance also decreases by the same amount.
Register now for free.